There are 3 power of sale signs on a single street in Brampton right now, and the families who used to live behind those doors did not lose their homes because they were reckless or irresponsible or financially illiterate. They lost their homes because a system that was supposed to protect Canadian borrowers quietly pushed them into a financial trap so well engineered that by the time they understood what was happening, the lender had already filed the paperwork and scheduled the auction. According to a May 2026 report published by Power of Sale Plus, which is a brokerage that tracks distressed property listings across Ontario, roughly 1 in every 20 GTA listings right now is tied to missed mortgage payments or a formal power of sale filing. Compare that to roughly 1 in 50 or 60 back in 2023, and you realize that this shift did not happen randomly or by accident. Data published by the Canada Mortgage and Housing Corporation shows that Canada's national 90-day mortgage delinquency rate jumped from 0.13% to 0.24% between early 2025 and Q3 of 2025. This represents an 85% increase in the share of Canadians who are so far behind on their mortgages that a forced sale is the next logical step. In Ontario, that number climbed by over 50% year on year, while British Columbia saw a nearly 39% jump in the same period. In Brampton specifically, according to data cited in a May 2026 Facebook post from the Toronto Culture page that aggregates CMHC and broker data, the 90-day delinquency rate has hit 0.6%. This is more than double the national average and the highest among all major Canadian markets, meaning approximately 1 in 20 listings in that area now carries power of sale status compared to roughly 1 to 1.5% back in 2022. The enemy here is not one villain, and that is actually what makes this story so hard to fight. The enemy is a layered system made up of federal mortgage stress test rules enforced by the Office of the Superintendent of Financial Institutions, combined with a real estate market that cratered after the 2022 peak while leaving borrowers holding mortgages priced at peak-era valuations. Add to that an entire shadow banking ecosystem of private lenders and mortgage investment corporations that stepped in to catch the borrowers the big banks were no longer willing to touch. These shadow lenders charge interest rates that run between 9 and 12% plus fees, usually on interest-only terms that eat a middle-class family alive within 6 to 12 months. A BNN Bloomberg segment from May 11 captured exactly this dynamic, where an anchor and analyst discussed how Ontario and BC are seeing a sharp uptick in 90-day arrears and power of sale filings, tying this directly to the 2025 to 2026 mortgage renewal wave that hundreds of thousands of Canadian families are being pushed through right now. And if you think the delinquency numbers are the worst of it, wait until you see the brutal math of what happens to a family's cash flow the moment a private lender gets their hands on the mortgage. To understand why so many Canadian families are ending up in the hands of private lenders right now, you have to go back to 2022, when the Bank of Canada had rates near the floor and the GTA real estate market was at an absolute frenzy. Detached homes in the suburbs were selling for well over $1 million and buyers were locking in mortgages at rates of 1.9 to 2.1% on 5-year fixed terms. At the time this seemed like a generational opportunity, but in hindsight it was the starting gun on one of the most painful wealth transfers in Canadian history. A typical buyer who purchased a home in that environment took on a mortgage of roughly $700,000 to $960,000 on a property that peaked somewhere between $1 million and $1.4 million. They put down 20% of their savings as a down payment and locked in that sub-2% rate, fully expecting that by the time renewal came around in 2027 either rates would be lower or their income would have grown enough to absorb a higher payment. What almost none of them modeled was the combined scenario of rates staying elevated and property values falling simultaneously. Historically in Canada, those two things did not happen together for long enough to do this kind of damage, but that is exactly what mid-2026 looks like, and the renewal cliff that analysts have been warning about for 2 years is now a cliff that hundreds of thousands of families are walking up to in real time. According to a March 2026 piece published by Canadian Mortgage Trends, the Office of the Superintendent of Financial Institutions has warned that as many as 150,000 Canadian borrowers could face serious mortgage stress over the next 2 years. They are confronting higher payments at renewal combined with a higher minimum qualifying rate and stricter lending standards. That number is not theoretical, it is a pipeline of families who are currently at or approaching their renewal date and discovering that the big banks will not take them at the new stress test floor. The stress test requires that a borrower qualify not at the rate they are actually being offered but at the greater of either 5.25% or 2 percentage points above the contract rate. This means that even if a lender is offering you 5.5% today, you have to prove on paper that you could afford a 7.5% payment. For a family whose income has not grown proportionally since 2022 and whose debt-to-income ratio is already stretched by inflation in groceries, gas, and daycare, that qualification hurdle is simply not passable. OSFI's own 2026 to 2027 annual risk outlook explicitly states that the agency is deliberately maintaining tight underwriting standards to protect against higher rate shocks. In plain language, this means the regulator's policy is intentionally keeping a significant portion of Canadian borrowers out of the chartered bank system, and those borrowers have to go somewhere. Where they go is into what the financial industry politely calls the B-lender and private lender market. A Bloomberg newsletter from March 2026 described this with considerably less polish as the shadow loan market that has been aggressively absorbing Canadians shut out by the banks. An analysis cited by Power of Sale Plus and cross-referenced with CMHC data notes that non-bank mortgage-style exposure in Ontario alone is growing at roughly 15 to 20% per year. Meanwhile, big bank mortgage balances are essentially flat, which tells you exactly where the flow is going and where the risk is building. A 2026 mortgage trends analyst stated that we are seeing a lot of borrowers pushed out of the big bank channel and into private lenders or B lenders, and that is exactly where the arrears and power of sale spike are coming from. That quote should be on a billboard somewhere in Brampton because it is the clearest description of the mechanism that is currently destroying middle-class wealth in Ontario and BC. But if you think getting pushed into a private lender is just a minor inconvenience, the math of what it actually costs a family is where this story gets genuinely brutal. Let us run the numbers concretely, because the abstract language of higher rates does not fully capture what is happening to real families right now. Consider a family that bought a detached home in the GTA in 2022 at a purchase price of $1.2 million, putting down $240,000 representing 20% of their life savings. They took on a mortgage of $960,000 at a rate of 2%, which gave them a monthly payment of approximately $2,700 on a 25-year amortization. This housing cost was roughly within reach of a dual-income household earning somewhere between $120,000 and $140,000 per year. Fast forward to their renewal in 2026 and the landscape looks completely different. Even at a major chartered bank offering a 5-year fixed rate of 5.5%, that same outstanding balance now generates a monthly payment of roughly $4,500. This represents an increase of $1,800 per month or about $21,600 per year that this family needs to find somewhere in a budget that has already been compressed by years of elevated inflation. According to rate tracking data aggregated by CTV News and Yahoo Finance, 5-year fixed rates at a lenders currently sit between 5.25 and 5.75%. In a best-case scenario, the family absorbs that $4,400 to $4,600 monthly payment and makes it work with discipline and sacrifice and probably cutting the family vacation. Fast forward to their renewal in 2026 and the landscape looks completely different. Even at a major chartered bank offering a 5-year fixed rate of 5.5%, that same outstanding balance now generates a monthly payment of roughly $4,500. This represents an increase of $1,800 per month, or about $21,600 per year, that this family needs to find somewhere in a budget that has already been compressed by years of elevated inflation. According to rate tracking data aggregated by CTV News and Yahoo Finance, 5-year fixed rates at a lenders currently sit between 5.25 and 5.75%. In a best-case scenario, the family absorbs that $4,400 to $4,600 monthly payment and makes it work with discipline and sacrifice, and probably cutting the family vacation. But here is where it gets genuinely catastrophic for the families that cannot clear the stress test at a big bank. Private lenders in 2026 are charging between 9 and 12% interest on residential mortgages, often on interest-only terms, to keep the monthly number from looking completely unaffordable on paper. They layer on top of that lender and broker fees of 1 to 2% of the loan amount rolled into the balance, according to multiple 2026 broker reports cited by Power of Sale Plus. Taking that same $700,000 outstanding balance and running it through a private lender at 10% interest only, the monthly payment jumps to approximately $5,830. This means this family is now paying over $3,100 more per month than they were in 2022, or an additional $37,500 per year in debt service alone. On top of that, they often owe $7,000 to $14,000 enrolled in fees that immediately increase their loan balance on the day they sign. For a dual-income household earning $120,000 to $140,000 gross per year, that extra $3,100 a month does not just squeeze the budget, it effectively wipes out all discretionary income and starts eating into fixed expenses. This family is now choosing between their mortgage payment and their car payment, between the private lender fee and their child's daycare bill, and that is not a sustainable trajectory for any length of time. A deeply distressing post on the Reddit community Personal Finance Canada reflects this reality by stating that they bought in 2022 at $1.9 million with $225,000 down. Now their house is worth maybe $1.5 million, their payments have doubled, and they are stuck with a private lender charging 10% because the banks will not qualify them. If they lose their job even for a few months, they are staring at a power of sale and a deficiency judgment on top of losing their entire life savings. That post has thousands of upvotes because hundreds of thousands of Canadians recognize their own situation in it. And the equity situation is even more damaging than the cash flow crisis, because the two are happening simultaneously. Families are bleeding cash every month while the asset they borrowed against is simultaneously declining in value to the point where it may no longer cover the loan. According to a May 2026 GTA-focused report cited across Power of Sale Plus and Toronto real estate data aggregators, average losses on Toronto area condos upon forced sale are running at approximately $56,000 per unit compared to 2022 peak values. Detached homes are averaging losses of approximately $165,000 per unit on sale, which means the collateral underpinning billions of dollars in private lender mortgages is materially worth less than it was when those loans were made. The scenario that is now playing out in Brampton, Mississauga, and parts of the 905 corridor is a textbook equity wipeout. A second Reddit post from the Toronto real estate community captures it raw, stating that their street in Brampton has 10 houses, and 3 of them have power of sale signs up as of May 2026. The lenders are dumping them at fire sale prices, which is crashing the block and making it impossible for anyone else to sell without losing their equity. It is a full-blown equity wipeout for middle-class families, and that is not hyperbole. That is the documented reality of a 0.6% delinquency rate in a concentrated suburban market. And the truly terrifying part of this story is what happens to a family financially once that power of sale auction actually closes, because losing the house is not the end of it. Under Ontario's power of sale process, the lender does not need a court order to sell your property, and they do not need to get you a fair price. They only need to get a price that is sufficient to cover the outstanding loan and their costs, and if the market has moved against you, those two numbers may not align in your favor. According to a mid-2026 analysis of Ontario power of sale cases cited by Power of Sale Plus, roughly 30 to 40% of forced sales in the current environment are now resulting in a positive deficiency judgment against the homeowner, compared to under 10% in the 2019 to 2021 period. This means that in a significant and growing minority of cases, the family loses the house, loses the down payment, and still walks away legally owing money to the lender. Using the numbers from our 2022 buyer scenario, if a family bought a Toronto detached home at $1.2 million with $240,000 down, held a mortgage of $960,000, switched to an interest-only private lender product to manage cash flow, and then faced a power of sale auction in 2026 where the home sold for $900,000 in a softening market, the math is brutal. The outstanding loan balance of $940,000 leaves a deficiency of $40,000 that the family is still legally required to repay even though they have already lost every dollar of their $240,000 down payment. A 2026 commentary based on OSFI's risk outlook warned that as private credit stress accumulates, if the private lender-backed mortgage market blows up, it will not just be a few hedge funds losing money, it will be banks, credit union funds, and pension plans that are on the hook, and that is exactly where the next wave of forced sales and power of sale filings will come from. That warning looks considerably more urgent now that the arrears data is confirming the pipeline. The best-case scenario is the one the government and the Bank of Canada would like you to believe is the most likely outcome, and it goes something like this. Rates continue to fall through 2026 and into 2027, the Bank of Canada gets inflation back to target and begins cutting more aggressively, and home prices stabilize rather than continuing to fall. OSFI quietly loosens the stress test floor enough to let a meaningful number of the 150,000 stressed borrowers requalify at chartered banks, easing the pressure on the private lender ecosystem before it hits a systemic tipping point. In this scenario, power of sale listings plateau through the second half of 2026, and the equity wipeout damage stays concentrated in specific markets like Brampton rather than spreading to the broader Ontario housing stock. The deficiency judgment wave stays manageable enough that it does not cascade into a broader consumer credit crisis. According to rate forecasts aggregated by Yahoo Finance in 2026, the consensus was for the Bank of Canada to cut rates by another 50 to 75 basis points through the year. This would provide some relief at renewal but almost certainly would not be fast enough or deep enough to rescue the families already inside the private lender trap at 10 to 12%. The honest assessment is that the best case requires a degree of policy coordination and market luck that the data does not currently support. The realistic case scenario is what the CMHC delinquency trajectory, the OSFI risk warnings, and the power of sale listing data are collectively pointing toward. It is uncomfortable but not catastrophic at the national level, even as it is genuinely devastating for hundreds of thousands of individual families. The 90-day delinquency rate continues climbing through the second half of 2026 and into early 2027 as the mortgage renewal wave processes another cohort of 2022 buyers. Power of sale listings in Ontario and BC stabilize at a level roughly double to triple the 2019 to 2022 baseline rather than the 50 to 60% above baseline seen earlier this year. The private lender ecosystem absorbs meaningful losses concentrated among smaller mortgage investment corporations and individual private capital sources rather than triggering a systemic banking event. In this scenario, the families most exposed are the ones who bought in 2021 to 2022 in the 905 corridor using high-ratio financing, shifted to private lender products at renewal, and are now watching their equity erode while paying interest only at 10+%. For those families, the next 2 to 3 years involves either a forced sale at a loss, a negotiated sale with a deficiency judgment, or a personal insolvency filing that wipes out the mortgage debt but destroys their credit history for 6 to 7 years. The worst-case scenario requires 1 or 2 additional shocks on top of the current trajectory, and reports on private credit stress and financial stability risks outline exactly what those shocks could look like. Much of the money financing private credit firms came from the big banks themselves, and a wave of private lender redemptions or capital calls could force fire sale liquidations of mortgage portfolios simultaneously across multiple Ontario markets. This would accelerate the price decline that is already undermining the equity positions of even borrowers who are currently current on their payments. In that scenario, home prices in the GTA fall an additional 10 to 15% beyond current 2026 levels, and the deficiency judgment rate moves from 30 to 40% of power of sale cases toward 50 to 60%. Insolvency trustee filings spike by a multiple of their current elevated levels, and a former Bank of Canada governor's warning of a 30% probability of Canada entering a recession becomes a realized outcome rather than a tail risk, with housing-related consumer credit stress as one of the primary transmission mechanisms. This is not the base case, but it is no longer an implausible fringe scenario, and the OSFI Risk Outlook document for fiscal year 2026 to 2027 is not written like a document produced by an agency that believes the situation is fully under control. If you are a renter in Toronto or Vancouver right now, this data presents a genuinely conflicted picture, and the honest advice is more complicated than most commentators will give you. On one hand, the power of sale spike and the falling prices in certain segments mean that motivated or distressed sellers are a real phenomenon, and negotiating leverage has returned to buyers in a way it had not existed since pre-2020. This is particularly true in the condo market, where the $56,000 average loss on forced sales represents a genuine price correction that renters turned buyers could theoretically capture. On the other hand, buying into a market where delinquency rates are rising, where private lender exposure is spreading systemic risk, and where the deficiency judgment rate is already at 30 to 40% of forced sales means you are potentially buying an asset in a market that has not yet found its floor. Locking in a mortgage at current rates on an asset that could continue declining for another 1 to 2 years is the same math that crushed the 2022 buyers who are now in power of sale proceedings, just at different price levels and rate levels. If you are a homeowner facing renewal in 2026 or early 2027 and you are currently at a major bank, the single most important thing you can do right now is start the renewal conversation 6 months before your maturity date rather than waiting for the bank's standard renewal offer. You should be negotiating aggressively across multiple lenders simultaneously, because the spread between what a bank offers a passive renewer and what they will offer an informed negotiator with competing quotes has historically been 20 to 40 basis points. On a $700,000 mortgage, that saves you roughly $1,400 to $2,800 a year. If you are already in or approaching the stress test rejection territory, speak to a mortgage broker who has genuine B-lender experience before your term expires. Being pushed into a private lender reactively after you have already missed payments is significantly more expensive than approaching a B-lender proactively while you are still current. If you are a homeowner already inside a private lender mortgage at 9 to 12% and you are currently making your payments but feeling the cash flow compression described in this video, the question you need to be asking your broker right now is whether your home's current market value still gives you enough equity to refinance out of the private product and into a credit union product or B lender at a lower rate. As property values continue to soften in some GTA and BC segments, that refinancing window may close before you expect it to. The Power of Sale Plus data showing that 30 to 40% of forced sales now result in deficiency judgments is a direct warning that the equity cushion many homeowners believe they have may be thinner than it appears. The time to act on a refinancing option is when you still have enough equity to qualify, not after 6 missed payments when the lender files. If you are a real estate investor looking at Ontario right now, the data is unambiguous that the GTA condo market in particular is a catching a falling knife situation that is still in progress. The combination of rising power of sale inventory, falling prices, and elevated carrying costs from current rates means the cash flow math on new acquisitions in that segment is deeply negative for a hold-to-rent strategy unless you are buying distressed assets at significant discounts to current market and planning a medium-term hold through the rate cycle. The investors who will likely look smart in 3 to 5 years are the ones who are selectively buying power of sale and motivated seller properties in strong fundamentals markets at 15 to 25% below assessed value today. They are not the ones who are buying at full market on the assumption that prices have already bottomed, because the delinquency data and the private lender pipeline suggest there is more inventory coming. You can find every single report and data point that we covered today linked in the description below so you can verify the numbers for yourself. I read all the comments on this channel, so please share how these economic shifts are affecting your household or your local market right now. If you found this breakdown useful, make sure to subscribe so you do not miss our next deep dive into the Canadian economy.